So I'll just finish the topic that we started, depreciation. We have completed it, but let me give you a quick overview of what we are dealing with. So essentially we are talking about book values terms like this, and we say that this kind of a method A is better than method B. And the reason I've been explaining to you is you can try to understand using this kind of a simple formula. Let's say your total income is I. The taxable income becomes some I minus D, which is your depreciation amount. So the net total tax that you are going to pay on this is, let's say, some small t rate into I minus D. So your net income that you finally get out of adjusting for depreciation is some sort of this kind of an expression, right? So now what we are doing is the value of this cash flow becomes maximum when D is higher or lower? Higher, basically, right? So essentially that's where all our assumptions have been suited for, that the earlier you get the benefit of higher depreciation, the better the method is. And that's the kind of approach that we are using also for your switching decisions that I just introduced yesterday, right? So always remember, this is how we came up to that. You don't have to memorize that concept, oh, depreciation has to be maximum. You can, by simple this concept, because it's a tax benefit, the higher the depreciation amount, the more the tax benefit for you, and that's better for your project. That's the kind of idea behind maximizing depreciation amount early in the asset life, right? Then we have many methods, sum of years, and then something called a sinking fund method. So I'm not going to revise all of them, but we ended up by one particular example where we were switching. We were making the switch of a depreciation method that we are going to start from the beginning. And in that also I've given you the criteria. At each year, you start calculating based on the book value that is instantaneous, using both the methods that you are comparing. The moment one method results into a higher depreciation compared to the other, you switch, right? So the kind of profile that we saw, we started with a DDB in the beginning, but then towards the end, the slope of DDB is not as high as perhaps other methods such as the straight line method. In that case, still allowing your asset to reach to the salvage value that you had estimated, which otherwise you will never reach if you were to use only DDB, then you can switch between a DDB to a straight line method. That's the kind of analysis we ended up with. Are you guys okay with that analysis, or should I revise a little bit of the calculations there? This example is making sense or not? Making sense? The formula of straight line also is slightly modified. Because you are calculating on instantaneous value, you divide not by the total life but by the remaining life that you need to depreciate, and that is coming out from n minus m plus 1. This m plus 1, because the book value that you are using is of previous year, so there is a additional convention of one time period that gets added here. Okay, everyone fine with this? Should I move on to the next topic? I just wanted to start with a basic overview of what we have done. And depreciation becomes quite important, especially when you are dealing with infrastructure projects, because infrastructure projects have they are huge assets. Like you could imagine $15 billion for a high-speed railway project. So depreciation amount is also significant, and the tax benefit that you can get out of it is also significant. So particularly if you are dealing with public-private partnership, where you are looking for private financing of these projects, the depreciation amount is quite an important aspect for their calculation, and everyone will report it. If you, we will also look at that later, but whenever you read a financial statement of any company or their balance sheet, in balance sheet they will report how much was their net revenue, how much was their operating expenses, how much was the depreciation, how much tax did they pay, how much tax after taxation. There's something called EBITDA. There's a term, I'll not go into detail, but essentially all that detail is available in any company's financial statement. So you can always look into that. All right. So with this, let me give you an overview of how the taxation happens. We have looked at the depreciation, but let's look at how this depreciation amount actually affects the tax calculation. And today's topic is just going to be slightly simple. It's not new concept that I am introducing. I've already introduced these terms, but essentially give you some sort of idea of what kind of problems could be formulated around the concept of depreciation and the taxation, right? Anyone here who doesn't know what tax is? Anyone? How many of you have experienced taxation? In CTAM, 15-20 people might have experienced. Is it a good feeling or a bad feeling? Very bad feeling. Yeah, it is. Especially in the Sarkari system, it is quite a bad feeling because you get a significant amount of taxation. But it's okay. The idea is the tax. Why does the government charge tax? It's essentially whatever income you are earning or profit that you are making out of your investment, not only your regular income, but if you are investing in some stock market, some financial instruments, the returns that you get are also taxable. The purpose is the government collects these taxes in order to spend on public infrastructure, in order to create a lot of social goods which otherwise would not have been created. But in India, how many percentage of people do you think pay taxes in India? Some rough idea. 10%? 20%? Anyone else? Somewhere about 10 to 15% is the total. Almost 70% people are not even in the purview of taxation because of dependency on the agriculture source of income. That straight away gets the benefit. Then there are promotion schemes from small and medium enterprises and things like that. And on an average, the middle class income, which is the regular income, salaried people, they are the largest in terms of the total contribution that we make. And then there are, of course, high net worth individuals, which because of their income is so high, they end up contributing a significant amount to the taxation. In tax, there are multiple type of taxation regimes which our country has, and of course different countries tend to adopt a different sorts of balance on where to tax more. In India, we have personal income tax, which is as an individual, whatever salary or whatever profits you are making out of your investment, you are liable to pay taxes on that income level. How much tax for personal income currently? Do you have any idea? Is it a linear system? Yeah, so there's a concept of income slab. So what government allows is it gives you some basic benefits, which basically you can reduce the amount from net taxable income, some sort of a deductions you are allowed. And after that, there is a slab system in a way that, let's say your income is 25 lakhs, your income, not mine. You guys will be earning more than me for sure. So the government says that for the first 5 lakhs, we will pay tax on, let's say, just 5%. For the income between 5 to, let's say, 15 lakhs, you will pay taxation of 10%. But then income between 5 to 30 lakhs, you will pay 30% or so. So your tax calculation, what will happen is, first 5 lakh, you will pay some 5%. Then for the, again, you will take another 10 lakhs from this 25. On that income, you will pay 10%. And then remaining 10 lakhs, which falls into this bracket, you will pay 30%. So that's how the calculation happens. It's not a linear function. But in our calculation, we'll assume a simple uniform rate so that your calculations become simple. Even in corporate income taxes, sometimes companies have to have this kind of a tax slab system, but sometimes corporates are also taxed on a uniform rate. So corporate taxes are slightly different than personal income tax rates. And of course, now in India, there is two regimes. There's something called old tax regime and a new tax regime. So old tax is more about promoting the savings, and for example, there are deductions which you can apply that ends up promoting you to save more. But the new tax income regime is more like you earn and then you pay. So it's on up to you whether you want to invest in the government based saving instruments or you want to invest in the market based instruments. Of course, market based instruments are a little bit more risky, but that depending upon individual, you can decide where to put. But yes, that is one way for government to earn money in terms of the budget that you get. One component is the personal income tax. Second is the corporate income tax. So corporate income tax is something that is charged to the companies. Each company has their revenues, each company has their expenses, each company has their depreciation. Using that calculation, they end up charging. Similar concept is something called a project income tax, which is concern of us because construction companies are typically project-based companies, because each company is at the same time they are doing multiple projects across different parts of India. So how the calculation of project income tax happens versus at the corporate income tax happens, it's slightly different. We will look into that differences in the examples here. Always pay attention. If you are dealing with taxation, you have to understand whether you are working at a project level or you are working at a corporate level. There is a slight distinction in this. We will know how to address that, right? And then there is something called, are you guys aware of VAT, value added tax? Or you guys know only GST? You know GST. So essentially VAT and GST are in principle same. The only problem in the VAT system was that the rates were not uniform across different states, because taxation is a matter of not only the central government but also the state government. So since this rates were not uniform, it used to create a lot of confusion, lack of transparency in the system. Therefore, nowadays we have replaced this value added tax system to something called a GST. And in that there is a uniform component of SGST and CGST. When you go to a restaurant, when you pay a bill, typically this component is given there, right? And it's a equal, whatever, if you are talking about 20%, 10% will go to state, 10% go to center directly. But currently the collection happens at center, and then center distributes that amount to respective states. That's how it happens. Originally, state would receive its contribution, then they would submit the remaining money to the center. So it's that kind of a scheme. If you consume, there are, even in food category, there are certain categories where you still have VAT. Any idea? Tobacco, alcohol, these kind of food products, they are still taxed under VAT system. So they are not under GST system. So if you see a bill which has this kind of components, you will be able to see that there's a VAT component, there's a SGST component, there's a CGST component, everything gets added in your bill. And then on top of that, there is something called service tax. Do you know what is service tax? So much taxation, see. On an average, see, on food products, if you are 100 rupees, if you're talking, state takes about 9 rupees, center takes about 9 rupees, and again another 8, depending upon restaurant, you can pay another 7 to 8 rupees on the service tax. So total you are paying what? 127 rupees for a 100 rupee food item. Yeah, so service tax is something which is by the nature or by the laws, I think a Supreme Court ruling or a High Court ruling, which made it optional. So you have, as a consumer, have right to refuse to pay the service tax. This is essentially the tip system. So originally you used to pay some tipping amount if you like the service, but nowadays restaurants upfront declare that we charge this. If you accept this, come inside. If you don't accept this, go somewhere, eat somewhere else. So it's really not a right of a consumer, because but yeah, sometimes you can still negotiate once you have gotten the bill and they might deduct it, but most of the restaurants these days declare it upfront that we charge this much service tax. If you like our terms and condition, please enter, otherwise find something else, right? So yeah, essentially as a consumer, you end up paying in at least 80-90% of the time. Rare, but that's a good thing. Now you don't have to negotiate for the tip amount. Now that you can straight away say, I have paid the service tax, I am not paying you additional tip amount. So don't feel obliged to pay tips in India now. But in US, this doesn't work. US is extremely a tip-based system. There, on an average, the tipping is again 15%, 18%, 21%. 15% if you want to get galis from the waiter, you pay 15%. If you want to get the blessings, 21%. If you just want a neutral reaction, pay 18%. That's the kind of treatment that you have. So it is, taxation is quite huge. Depending upon, some countries have a different focus on these taxation systems. For example, in a lot of these Scandinavian countries, Norway, Sweden, they have a very high tax regime. On a personal income, they end up charging you more than 50-60% of your income goes away in taxation. But then everything else is taken care of. Your schools are free, your healthcare is free, your transportation is free. So all those things gets taken care of. So that's the one model that has been working for those countries, and the people really enjoy a really good quality of life there. The other side of it is people don't charge anything on the personal income tax, but they only charge only on the goods that you consume. For example, Dubai. There is no personal income tax on Dubai. You get, if they promise you 7,000 dinars, you will get 7,000 dinars in your pocket. But as you consume, if you are a consumer of 1 unit of Coca-Cola versus 2 units of Coca-Cola, you pay tax for more consumption that you are having. And that's a model that's working for them because it promotes consumption, and because of the high consumption, people are still able to, the government are still able to collect the income. In India, we have both. You pay taxes on the personal income tax and then you pay GST on each. So if you do a rough calculation, welcome to the reality. Approximately 40 to 45 rupees is what remains in your pocket net in India after your consumption. Like only for your consumption. Rest everything goes in the taxation system in India. That's the kind of calculation. Most of you will work in the slab tax of this 30% rate. So immediately you will end up paying on an average roughly about 20 to 25% of your income immediately goes in taxation. Then you are dealing on remaining 75, you are dealing with 20% VAT or this GST on an average. So again a 0.8 multiplier. So you get what? Somewhere about 65%. In that 65%, you will invest money here and there, all those things, you're done. Essentially, the net income that you get is not that high. And at the same time, you really do not enjoy the benefit of the public goods that are created. Our roads still need a lot of improvements. Our healthcare system still needs an improvement. Not to blemish the country, I think if once you start going abroad, you will realize how good Indian healthcare system really is. Once you go abroad, you will realize how really convenient our system is. Healthcare prices, insurance prices, anywhere in the world are beyond affordability level. But in India, you can still enjoy that because of there's a lot of good that our country's system allows us to do. So it's not completely a lose-lose situation for you. But right now, you'll not be able to appreciate it. Once you start earning in dollars and spending in dollars, then you will know how much the healthcare system really costs there. But in India, for a middle income country, middle income household at least, healthcare is really affordable that way, right? But yeah, again, we are not going into this. Class is not about the taxation system, and of course, I'm not even an expert in all this, but I'm just giving you an idea and more from a personal perspective, not from a policy perspective. Of course, it's much more complicated in terms of how to balance, depending upon which where you're most focused on is, like are you focusing as a government collecting more a personal income tax versus the value added tax. It also has an impact on welfare, access to welfare services, not only for middle income, but also for the, at least in our country, the really marginalized people who can really get benefit out of this tax subsidies and all. So it's a very strategic decision. It has huge impact on people's day-to-day lives because ultimately it affects on how much net income you have for yourself and that you could use for whatever cost that you have in individually. So this is the kind of idea that you are, just give you some overview of what taxation is. Again, I've already made this quite red, but we are going to focus only on these two parts. One is the corporate income tax and a specific case of that, which is the project income tax, because particularly we are dealing with construction projects. Okay. All right. So corporate income tax, how does it get calculated? Step-by-step formula is given to you here. The net operating income for a corporate is defined as the revenue. Revenue is by getting sales, the quantity of sales versus the price that they which was selling, that's their revenue, minus their operating expenses. So in order to generate revenue, they need to pay some expenses for staff salary, for equipment uses, for land lease and all. That becomes the operating expenses. So this taxable income then becomes the net operating income minus the depreciation amount that you can ideally calculate using different formulas. The tax rate, assuming that there is a uniform tax rate on net income. Ideally, this is not the case, as I told you before, but let's for simplicity assume that this is a fixed percentage of the taxable income. Let's say 20% of the taxable income, 30% of the taxable income. Then your income tax becomes the tax rate multiplied by the taxable income, right? So your net operating profit after taxes becomes your taxable income minus the income tax that you have paid, right? This calculation is making sense? Pretty simple. Net operating income is revenue minus expenses. You should not be paying expense like taxes on expenses. So your revenue is not straight away taxable. You are allowed to deduct your expenses on that. Your taxable income further gets reduced because you are taking into account the depreciation amount. Your tax rate is some fixed percentage of the taxable income. So your income tax in that becomes the tax rate multiplied by the taxable income. So your net operating profit after taxation is your taxable income minus the tax amount that you have paid, which can become this kind of a simple formula. Make sense? Right? Now, as I mentioned, the T can be an average tax rate or it could be a bracketed tax rate, or in India we use the term slabs, tax slabs. So here just example is given to you. So for example, this I think I've taken from a book and it could be a US system. So what it says is that between 0 to 50,000, the tax is 15%. Between 50,000 to 75,000, the tax is essentially the 15%. If your income is between 50 to 75,000, let's say your income is $65,000. So on the first 50,000, you are paying what? 15%, which is $7,500. The remaining 10,000, not 10,000, the remaining $15,000 you will be paying on 25% rate, which will come out to be some value, right? That's how the tax slab system works. First slab, you pay for that money. Remaining amount, you put in the second slab, you calculate tax on that, and so on and so forth. You can also, depending upon what your income level is, you can on an average tax rate also you can estimate. So in our simple calculation, we are assuming that we have a average tax rate information available to us rather than going for this slabbed track. If we are going for a slab system, then this formula is not as simple. Then you need to actually estimate depending upon your income level and then deduct it here. Okay, this concept is clear. Now, the key difference between a corporate income tax and a project income tax. The key difference is that in your corporate income tax, you are actually assuming that the depreciation amount is a real cash flow, in a way that it is going out of the system, in a way that the company is keeping this amount invested somewhere so that they can actually get the replacement when the asset requires so, right? So in a taxation system of corporate, it is a real cash flow. Depreciation amount is considered as a real cash flow, money that you have kept aside in order to replenish your asset once the requirement comes so. So therefore, this kind of a formula works out and this is the calculation, okay? The only key difference between a project and a corporate tax is that in project, the depreciation is not a real cash flow. You assume that it is kept aside, but it is not actually taken away from the project. Its money still stays within the project, and that's the only difference between a project cash flow and a corporate tax flow. Let me show you the example, right? So this is what you will be dealing most of the time in project, in our exams also, because we are dealing with individual alternatives. and individual alternatives are more or less a project, not of a entire company's business. In most of our cases, we are not modeling the whole corporate, we are modeling alternatives, or we are talking about minor projects or some specific projects kind of a decision. In that, the cash flow, the depreciation is treated slightly differently. How? Let me show you here. There's a concept called cash flow before tax. Okay. What happens is revenue goes on the positive side, the operating expenses goes on the negative side. If you are making any initial investment, that goes on the negative side, and the salvage value whenever you are getting, this becomes the net cash flow before taxation, right? For each year you can estimate that. Now your taxable income is still CFBT, which is the cash flow before tax, minus the depreciation amount. Make sense? Right? Your tax rate, assume same uniform tax rate, income tax, again tax rate into taxable income. Now cash flow after tax is cash flow before tax minus the income tax. Okay. So the formula becomes cash flow before tax minus T, which is the tax rate, into this cash flow before tax minus depreciation. So this is slightly different than this simplified term that you were able to get here. Where do you think this difference is coming? Yeah, so basically the amount that you are subtracting, here you are subtracting from TI minus I, but here you are subtracting from cash flow before taxation minus I. You are not subtracting from taxable income minus I. Got the idea? Why the difference in terms is coming? And this essentially tells you that in our case, depreciation is not an actual cash flow. You are not considering it as a money going out of the system because cash flow diagram is still there. But at a expectation is also that if a company is executing multiple projects, they will ultimately keep the money, some money aside. So they will balance it here, but ultimately they will keep it some money aside in a separate account. How to go from project to corporate? If you know, please teach me as well. I don't know the details of it because this is heavy finance and accounting stuff. I have not gotten so much into it, but perhaps as I mature in this class, I will include that part as well. How do you actually do the accounting system when you are dealing with multiple projects, but on a HQ level, how does the accounting system happens? But got the idea? How the corporate tax happens and how the project taxation happens. Okay? Concept wise is simple. Let's look at some of the examples of how tax affects the decision. If it affects or if it does not, how to do this kind of calculation, right? Yeah. One more thing, in particular to projects, if you are getting a negative taxable income because of some reason, because the depreciation amount is too heavy, or in certain area like certain key areas you made an initial investment and so on and so forth, if the negative value you are getting, so it is assumed to be tax saving in that case for that particular project rather than just keeping it as a zero. So you still apply the same formula, but whatever the money that, in this case the net tax income would come out to be negative, but that could be added as a positive for your overall calculation. So it's assumed as a tax benefit. Okay. So let's look at an example. You have equipment A versus equipment B. The initial costs are given, the operating costs are given. The economic life for both are same, and this assumption needs to hold true because you are comparing two alternatives and we are doing on the project present worth kind of analysis method. The corporate tax rate is going to be 50%. It's a corporate tax. Okay, that's the rate that has been given to you, and the salvage value. How do you do it? So this is the alternative 1 versus alternative 2, or A versus B before taxation. A is 12.5,333 for 5 years, B is 7.5, 5.5 for 5 years. So in this case, if you do the calculation, you will find that equipment A is preferred over equipment B. before the taxation. If you do the calculation, present worth you will find equipment A is preferable to equipment B. Now, after tax evaluation of alternatives, so operating cost is 300,000 and 500,000. Depreciation amount using a straight line method. So in this case, equipment A, there is no salvage value given. So we are assuming, oh, salvage value is given 0. So your total amount that you need to depreciate is what? 12,50,000 over 5 years for project A. So that will come out to be 2,50,000 rupees per year. And for equipment B, the total is 7,50,000 divided by 5 because you are dealing with straight line method. That comes out to be 1,50,000, right? So total amount for taxation becomes your operating cost is already negative. The depreciation is a negative amount. So it becomes a sum of minus 5,50,000 and minus 7 lakh in this case, right? But since we are dealing with a negative taxable income, we assume that this is kind of a benefit instead of actual tax happening. Since you are dealing with a 50% rate, so the actual tax benefit is 50% of this amount. This is a very crude example just to give you concepts of what is happening, what is not happening. And then the net cost per annum becomes this amount minus the tax benefit that you have gotten, because tax benefit is a positive and the net cost is minus 550. So this becomes, no, wait, no, operating cost is here. So you have to deal with, because cash flow before tax minus the tax, that's the money that is cash flow after tax. Okay, don't get confused for this. I think I should change this language here. Corporate tax rate. Ultimately, you are dealing with a project here. It's not a corporate tax, but it is. I took the question from somewhere and that's where it was mentioned. It's a project tax rate calculation happening. So, your concept is cash flow before tax, depreciation, cash flow before tax minus depreciation, income tax, cash flow after tax, which is cash flow before tax minus the income tax. Got it? Now the calculation is making sense. So your net operating cost before tax was minus 3 lakh. The depreciation amount is 2,50,000. The total amount that you could consider for taxation is minus 550, which is rebate because you are dealing with negative cash flow in a project environment. So it becomes a 2,75,000 is the rebate that you are getting. So your net cash flow after taxation becomes this particular amount. Okay? Understood? So your revised cash flow series after taxation for alternative A and alternative B can become this series. Okay. Then normal net present worth, you actually do your analysis and you will find in this case you will still end up choosing equipment A. Originally also you were choosing equipment A, but after taxation in some cases the alternative selection may change. That could happen, well could happen. Okay. And this is based on the annual worth method. Again, equipment A because it costs less. You can also do this analysis on the IRR method. So you make an incremental series, you calculate the IRR by linear interpolation, and you will find that IRR is coming out to be, of this incremental series is coming out to be 21.53%, which is greater than your MARR of 10%. So you still end up choosing alternative A. This is just a reminder of some of the concepts that we have learned before. Clear so far? Not a tough concept to handle. Now, effect of taxes on different depreciation methods. Sometimes depending upon the depreciation method you choose, the overall taxation and everything can significantly be influenced, and that's what we will look at here through one simple example, not too complicated. But let's say a $50,000 machine is proposed. the cash flow before tax for the machine is assumed to be $20,000. If recovery period of 5 years is given, use the present worth of taxes criteria, effective tax rate of 35% and a yearly return of 8%. Compare the following. Which tax method is better? Classic straight line or classical double declining balance method. Okay. So, cash flow before tax is $20,000 for each of the 5 years. In classical straight line method, the depreciation amount is how much? Since salvage value is not given, you are assuming it to be 0. 50,000 divided by, okay. So, the depreciation amount in each year using the straight line method is 10,000. So, taxable income is what? CFBT minus DT. So, this also becomes $10,000. The tax rate is given to be 35% uniform. So, the actual tax amount that you are paying is $3,500 uniformly, right? Same thing if you do using double declining balance method. What is the fraction? 2 by, which is 0.4. So, your taxation amount in year 1 becomes what? 50,000 into, right, 20,000. Then you do the calculation, you will find this. Can you see if this table is correct? DDB method. 50. So, the depreciation amount in first year is 20. The book value is 30. Depreciation amount in second year is what? Depreciation amount is 30. 12. So, the book value is depreciation amount in year 3. 18 into 0.4, which is 7.2. Remaining is how much? 10.8. Okay, I'm not able to type there. What is 10.8 and 0.4? 4.32. Remaining 6.4. Okay, 6.4. 6.4 multiplied by 0.4. What's the tax? What's the depreciation? And the remaining amount will be what? 4 point something. No, 3 point something. Okay. So, this table is correct. So, taxable income is essentially what? CFBT minus DT, first year 0 and then this much amount. On that, the taxes that you pay is 35% of this whole calculation, the taxable income. So, that comes out to be this one. Where are you paying more taxes? I have been telling you so far that DDB method is better, but you are paying more taxes. Why? Can you take the present worth of this tax series and present worth of this, which is coming better? What is the present worth of taxes in this case? 14,139. And for this one, straight line? 13,975. Use the formulas differently. Everyone's getting the same answer? No? So, you see the present worth of the tax is also coming out to be better in straight line method compared to DDB. While in my entire last class, I have been telling you that DDB is better than straight line method. What's happening? The statement that I made so far is true when ultimately you are reaching the same salvage value. In this case, the DDB based calculation is not reaching the salvage value of 0, which your straight line method is able to do. But your DDB method is not able to do. So, whatever, all that formula that I had shown you, the starting point and the end point of all these series were same. Only in that you were able to make that statement that a higher depreciation in early stage is better. It's not an absolute statement, but it will be a true-false question for you guys. So that's the idea. So definitely you need to have a switching. Somewhere in between you need to have a switching so that finally you reach the same salvage value. So in that case, the curve will become, if this is a straight line, this is what is happening right now. In that case, the curve will become something like this. So if this is the scenario where you are switching, then the higher depreciation in the early stage is better. So the starting point and the end point in these series is same. Only then you are able to make that statement. Otherwise, it's not always necessary that DDB is a better method. In that case, you need to then switch between DDB to SL or whatever. Okay, this concept is clear, how taxation with different depreciation method will be playing out. Then I'll just give you one final example also here. So in this case, the company just purchased an asset for $90,000 with an estimated useful life of 9 years. However, a shorter recovery period of 5 years is allowed by the tax law. Indian, because I just wanted to change something in the problem statement, but ultimately it's a taken off problem. Demonstrate the tax advantage of the smaller n if net operating income is $30,000 per year, an effective tax rate of 35% applies, and invested money is returning 5% per year after taxes. The classical straight line depreciation is allowed. Neglect any effect of salvage value. So what I'm trying to say is, you need to estimate, if I make this life shorter, is it a tax advantage? From 9 years to 5 years, keeping everything else same, is it a tax advantage or not? That's what we are trying to do in this particular problem. So case 1, useful life is 9 years. Your depreciation amount each year is what? Total amount that you need to depreciate is what? 90,000. No salvage value. Salvage value is 0. So 90,000 divided by 9 periods. So that becomes 10,000 each year. The taxable income is what? 30,000 is your net operating income minus the depreciation amount. That becomes 10,000. So this is 20,000 per year. The taxes in this case is what? 7,000 per year. The present worth of this tax will come out to be P by A, 9 years, and this 5% is the rate of interest given to you. Don't use 35% tax rate here. Read the question carefully. Just because it is percentage does not mean it is an interest rate that you are going to use in your problem. So this comes out to be 49,755. The total amount that you are paying in taxes is 7,000 for 9 years is $63,000. Okay, this calculations make sense? Suppose the recovery period is 5 years instead of the original 9 years. So your depreciation have this kind of a formula. You are depreciating the asset faster. In first 5 years, you are depreciating it the entire amount in just 5 years now. So this is coming out to be $18,000. No depreciation between years 6 to 9. Right? So taxes for year 1 to 5 is 35% of 30,000 minus depreciation amount, right? This is coming out to be $4,200, and for the year 6 to 9, this is coming out to be what? 0.35 into 30,000 minus 0, because there is no depreciation happening in this alternative. So this comes out to be $10,500. Now take the present worth of the total tax, 4,200 P by A, 5% 5, 10,500 P by A, 5% for 4, and adjusted to P by F, 5% 5. This calculation is fine, or you are not able to understand? I think this is fine. So the total you get is, in this case you get is $47,356, and the total tax that you have paid is $63,000. So you see the $63,000 remains same. Total tax you have still paid 63,000, but in time value of money, option 1 is better or option 2 is better? Option 2 is better, where you are paying the higher depreciation in the beginning. The present worth is maximum in that case. Even though the total tax amount you are paying in this case is same, distributed over the entire time, the net present worth of the tax that you are paying is lower in the second case, which is a shorter life case, higher depreciation case, and therefore that is better for you because you don't want to pay high taxes. So this is in general kind of concept. You can also use this rule of thumb. So whenever there is a constant single tax rate system, like you are using a uniform tax rate, your cash flow before tax is more than the depreciation amount. Both methods that you are using are reducing the book value to the same salvage value, and the same depreciation method is being applied. With all these conditions, I am saying the total tax paid are equal for the entire life, but the present worth is smaller for smaller tax life. Okay, make sense? Nothing much to do with this in real life, but I just wanted to show you how taxation can help you, or it can influence your cash flows, and therefore some of these rule of thumb you can also derive by keeping other things varying and keeping some things fixed and so on and so forth. Okay, all right. So this is where we'll leave the class. Oh, I'm already 2 minutes late. We'll start with a new topic tomorrow.